Okay. All right. You're welcome, guys. So we'll start immediately. So fundamental, this class about news events is part of what we call fundamental analysis. Fundamental analysis, right? So the market there are different kinds of analysis that we do in the forex market. Number one is fundamental analysis. The second one is technical analysis. The third one is sentiment analysis. Sentiment analysis. So all of these are very broad, and in the course of our trainings and all that, we will go through all of them and be able to help us understand all of these things, because it's important for you to actually win in the forex market the way you are meant to win and achieve the goals you have for the financial markets. You really need to understand the different parts to it. Fundamental analysis, technical analysis, sentiment analysis, right? So all of these things are meant, they are parts of trading that you are meant to understand clearly for you to be able to win properly, all right? So on this topic we have today that has to do with news events is part of fundamental analysis. Fundamental analysis is basically broad and is based on, it has to do with the news events that move the market, the economic events, the political events, every event that moves the market, everything that happens out there, be it war in Ukraine, be it China, COVID situation, be it the COVID that happened before, be it the elections in the United States, all of these affect the markets. All of these affect the market. So all of this is part of fundamental analysis. So in the course of this class, guys, just follow. In the course of this class, you get to understand the things that move the market and how you can take advantage of them to trade profitably. You see, so that's what this is all about, and it's a very, very important class, right? As we go on, you will see why. So we'll get started immediately. You're welcome, everybody. Thank you for being here. So we'll get started immediately. Okay, so there are several key economic events that tend to have a significant impact on the forex market, right? So like we see, like in this class, guys, you are going to be seeing the things that affect the market, and it's very, very important. Okay, this was something that we were discussing. Some people in the group were discussing a few days ago, and they were like, oh, this is because they began to see that this is very, very important. So I decided, okay, we're going to have a class. I told them we're going to have a class like this, and then this is it. All right, so let's go on. Number one, interest rates. Interest rates by central banks. This is the number one thing that affects the market. It affects the market because, hey, central banks have two, I call it the dual function of the central banks, or serious central banks. There are some central banks that are not serious, especially several of those in Africa. I'm sorry to say, but there's the way certain central banks behave, operate, it looks as they act as though they're not serious. But basically, for serious central banks, Bank of the Federal Reserve of the United States, the Bank of England, the Bank of the European Central Bank, you talk about you talk about all these central banks of very developed countries. They have a dual role. They have a dual role, and the number one thing they have to do is stabilize prices. Stabilize prices. Number two is make sure there's full unemployment. Number one is stabilize prices. Number two is make sure there's full unemployment in the economy, which means that it is the central bank's job to make sure people are fully employed. Okay, there's full employment in the system. And then the second thing is their goal is to regulate prices, make sure prices are stable and prices are not just skyrocketing anyhow. We talked about this in the last class we had. Okay, so interest rate is the tool that the central bank has to control inflation. Inflation is stable. So when I said they are dual role, when I said the central bank has a dual role of maintaining stable prices, what I'm actually saying is that they control inflation. What I'm actually saying is that they control inflation. Please mute yourself. When you come in, mute yourself, please. Mute yourself. Mute yourself, please, and put off your video. Put off your video. Put off your video. Off your video, please. Thank you.
You told me everything. I told you. Told you repeatedly that you regret everything. I was my father, my mother, my brother, your sisters, all everything.
Techno Spark, please keep your sound off, please. Keep your sound off, please. I'm putting it off, you are putting it back on, please, so that we can proceed easily. Thank you. Okay, so like I said, interest rates is one of the interest rate decisions by central banks is one of the things that move the markets, right? So interest rates is one of the tools, one of the major tools that the central banks have that they use to stabilize prices in the system. They use it for stable prices and they use it for stimulating the economy. Like I said, there are major roles. The two major roles of the central bank is number one, stable prices, stabilize prices, make sure inflation is low and make sure prices are stable. That's the number one thing central banks are mandated with. One of the roles that the central bank is mandated with. That's number one. Number two is full unemployment. Full unemployment, which means that the role of the central bank is to stimulate the economy, make sure the economy is working and booming, so that industries can take monies from banks, can borrow monies, can invest, and then eventually create employment. So their role is to make sure that there's full employment in the system. And the interest rate is one of the tools that they use to do this. When inflation is high, as it has been for the past 1 year, what the central bank does is that they increase interest rates. They raise interest rates in order to slow down the economy so that inflation can come down, right? So, but when the inflation is low, when the economy is not doing well, just like during COVID, when the economy was shut down and the world was trying to rejig, basically trying to rejig the economy, what the central bank did, most central banks did, was to drop interest rates. Like in places like the United States, they took interest rates to zero. So you could borrow money, people could borrow, individuals could borrow, companies could borrow, basically stimulating the economy. And that's why the American economy recovered from COVID very quickly. In fact, it recovered from COVID so much that inflation now set in. Because the strength of when the economy is booming and strong, there's a tendency for inflation to set in. So this is why interest rate decisions are very key. As we go on later on in the class, you will see the exact interest rates. These events interest rate events, you will see what they are called for different economies and what they do, when they come out, when are they released. Because these interest rate decisions are done every month. Well, not every month. They are done for probably 8 months of the year, 7 to 8 months of the year. Most central banks do this interest rate, release these interest rate decisions 7 to 8 times every year. Okay, and then in this class also we'll be focusing more on the interest rate decisions of developed countries, of the United States, of Canada, of the UK, Europe, the Eurozone, of Canada, and all that. Because we are traders, guys. We are not just in the market to play. We are not in the market to just look. Okay, we are not economists per se, but we need to understand what economists do in order for us to be able to make profit from the markets. Okay, so we are not here to just learn. We are here to learn and use the data, the information that we have to make money. That's the goal. Use the information that we have here to make money, right? Okay, so that's what interest rates are. So interest is one of the things, one of the events that move the market a whole lot. Okay, that's number one. So let's move to the next one. The next one is inflation. Inflation is also known as the CPI. It's not that the Consumer Price Index, CPI, Consumer Price Index. Consumer Price Index, right? Inflation is a measure of how much prices are rising in an economy. and is closely watched by central banks and investors. Yes, the reason why it's closely watched by central banks and investors is because when prices of goods and services goes very high, it causes instability in the pricing system of the country. So that has a tendency of doing a lot of damage to an economy. So high inflation has a tendency of doing a lot of damage to an economy, right? So that's why central banks watch it a lot. The central banks don't joke with inflation. Inflation is one of the things. It's more like when they see it's just like when you're in a house and you see a serpent, a snake or something. You don't sleep in the house with a snake. That's how to an extent, that's how central banks see inflation. They want to kill it before they go and sleep. If you see a snake in your house at night, what do? You're not going to go and sleep. You make sure you get it out of your house before you go to sleep, go to bed. That's how central banks treat inflation, because it can be very damaging. So they watch it and then they take care of it. And like I said, there are tools for taking care of inflation is interest rates. So high inflation can be bearish for a currency, as it can indicate that a central bank will raise interest rates to combat it. So that's what central banks do. Whenever there's high inflation, central banks tend to raise interest rates, increase interest rates, in order to take care of it. And when we talk about interest rates, we are talking about the interest that you pay when you borrow money. If you're borrowing money, whether you're doing individual borrowing, as an individual, you could be working and then you take a loan to settle some personal bills from your bank. Maybe you work and your salary is domiciled in a particular bank, and you decide that, okay, I want to borrow money from this. There are so many banks that give consumer loans, individual loans to you. But when you take that loan could be for your personal needs. That loan could be for a car. It could be a mortgage, right? So if you take that loan, when you're paying back that loan, you're not just paying back the capital, you're paying back interest. And that interest, the amount, the percentage of that interest is determined by the interest rate the central bank sets. That's how it affects the economy. If central bank sets a high interest rate, that means you that is borrowing, you as an individual, that's borrowing money from the bank for your personal needs or for your personal stuff, to pay for a car or something, your own interest that you're going to pay to the bank is going to be high, because the central bank has set a high interest rate. But if the central bank sets a low interest rate, your individual debts, your individual loans that you go to a financial institution to take becomes reduced. You see, and basically when the interest you are paying is little, there's a tendency for you to borrow more. But when the interest rate is prohibitive, somebody says, come and take money, but you are going to pay 10% every month. That's crazy. How do you pay 10% every month? What are you going to do to make money to pay 10% every month? Right? That's it. Except you're playing in the financial markets and you are really skilled at it. Most businesses cannot make money and pay 10% every month. They cannot make money, pay 10% and still be liquid and still have funds. They are still be in business. They can't do that, right? So that's the impact of this. CPI inflation is very, very important because the central banks watch it in order to take care of it. That's another one. And this data, most of these data are released every month. And whenever they are released, it affects the market in a very drastic way. That's why we are going through this, because this is for trading. This is not just for knowledge, this is for trading. Okay, so as we go on, later on in the class, you will see what these data are called. Each of these data, what are they called and when are they released? You see, then we'll keep an eye on them. Like this week right now that we are in, today is Tuesday. By Thursday, there's going to be a CPI released. This CPI inflation data is going to be released in the US this week, Thursday. And that inflation data, the whole market is waiting for it right now. And it's going to hit the market. At the time that data is released, you will see the market will go ballistic. It will go haywire, right? So that's why we are watching it. When these numbers are released, it can change the entire direction of the markets in one moment of time. it will change the entire direction of the market. If everything was bullish before, it will turn bearish. If everything was selling before, it starts to buy. If these inflation numbers go in the way, when these inflation numbers are released. So on Thursday, we're going to be keeping our eyes on this. Let's go on. Employment data. So this is also so important because we said earlier, two things affect, two things are basically the mandate of central banks: stability of prices and full employment. So just like the central banks watch the inflation reports to make sure to know what's happening, whether the inflation is increasing or decreasing or stagnant, they also watch the employment data. Employment data is as important as inflation as well. Well, their employment has a lot of effect on inflation. Employment has a lot of effect on inflation. If you are in an economy, for example, like the US right now, the US economy is very strong right now. A lot of people are employed. In fact, there is the demand for labor in the US right now is far more than the supply of labor. So there's a lot of jobs that are not filled because there is not enough people to fill them. A lot of jobs, not enough people to fill them, right? But in such an economy, what happens to wages? Wages will increase. And when wages increase, it means people are making more money. It means that now people have more money to buy more goods. Even if prices of goods increases, they can still pay because they have money. So you see how and that will lead to inflation. So you see how employment and inflation can be very, very, very interconnected. Employment and inflation can be very interconnected. Okay? Yes. So please put off your video. Put off your video, please. Thank you. Off your video. All right, let's proceed. Okay. So if you're just coming, welcome. We've started already, and this class is being recorded, so we'll just proceed. So employment and inflation are very, very, very interconnected. Okay, so let's go on. So the next thing is GDP. GDP is gross domestic products. Gross domestic products. Yes, good evening. Gross domestic products. Okay, so now gross domestic product is a measure of the country's economic growth and health. And changes in GDP can indicate whether the economy is expanding or contracting. Positive GDP data tends to be bullish for the economy and for its currency, while negative GDP can be bearish. So GDP is basically the whole economic, the sum total of the economic activity within a country in a year. The sum total of the economic activity within a country within a period of time. It could be 12 months, it could be 3 months, in which case we are talking of GDP per quarter. Okay, when it's 12 months, it's GDP per year. So they'll say year over year. They'll measure it from last year to this year. That's GDP year over year. Okay, then they can measure GDP month over month, which means they are comparing the GDP of this month to the GDP of last month. Okay, it could be GDP of, they could do it quarter by quarter. So they could be comparing GDP for this quarter to the GDP of the previous quarter. The quarter is 3 months, right? So when these GDP numbers are increasing, it means that the economy is doing well, the growth, and the economy is strong and healthy and growing. That's the meaning. That's what it is. If the GDP numbers are reducing, if the GDP numbers for this quarter is worse than the one for last quarter, if GDP numbers for this quarter is lesser than the GDP numbers of the last quarter, it means that the economy has shrunk. It means that the economy is not doing well. It didn't do well this quarter as much as it did last quarter. So economies are supposed to grow. That's why you see every year, you see economic forecasts from the IMF, from JP Morgan and all that. They tell you how much the world economy is supposed to grow. Because the economy today is bigger, far, far bigger than it was 50 years ago, 20 years ago, 25 years ago. So it is there, it is yearly growth, this yearly growth, GDP growth that makes the world a bigger place, make the whole world market a bigger market. You see, so an economy is supposed to grow, not shrink. And when economy shrinks, that's what you call a recession. When the GDP for this quarter is lower than the GDP of the previous quarter, and then the GDP of the previous quarter is lower again than the GDP of the previous quarter, that's what you call a recession. Please mute yourself, thank you. That's what you call a recession, okay? That's what you call a recession. So a recession is basically shrinking GDP. From quarter to quarter, GDP is reducing. That leads to what you call a recession. It means the economy is not doing well. And this data is important as well, because everybody watches it. How is this economy doing? Because whenever the economy is doing well, it's going to be good for the currency of that country. Whenever the economy is not doing well, that means it is poor, it is bad for the economy of the country. So therefore, it is bad for the currency. Whenever, remember this, guys, the currency of a country is like the stock price of a particular company. When Apple is doing well, the stock price of Apple will rise. That's sensible. That's, everybody can know that, right? If their stock price is going to be better as long as the company is doing well. But if the company begins to lose money, and the company starts losing money every year, or every quarter, what happens here? Investors start to dump the shares, which means that the share price is going to drop because the company is not doing as well as it should do. That's one of the challenges that Tesla is having right now. Tesla as a stock is having right now, because the company is not doing as well as it was doing previously. And of course, it doesn't even matter why the company might be doing poorly. So it could be doing poorly because of geopolitical issues. There's war, there's COVID and all that. If an economy is still doing poorly, irrespective of why it's doing poorly, the currency will still go down. Just like a company, irrespective of why you are doing poorly, your stock price is still going to drop. So think of currency, think of the currency of the country as the stock of that country. Just like you think of stock as the stock of a company, think of a currency as the stock or as the share price, as the shares of a particular economy. So if the economy, going back to GDP, if an economy is doing well, is booming, the currency will be better. If the economy is not booming, the currency will be weaker. So let's go on. Then political events. So political events such as elections and changes in government policy also have a big impact on currency values, as they can indicate a shift in the country's economic or foreign policy. Okay, let's pick an example. The United States had elections in November. And when that happened, it led to a little shift in the permutations of government, right? A particular party, I don't mention parties now, a particular party controlled the House of Representatives before, and another one controlled the Senate, right? Now, those that were controlling the House of Reps were the ones in power, the ones in, the ones in the president and all that was in that party that was controlling the House of Reps. Then the Senate was controlled by the opposing party. Right now, that elections that happened changed some dynamics. Right now, the Speaker of the House of Reps is somebody from the other party. So that right now, when that elections was done and released, it affected the market because the investors are already seeing, investors could see that the outcome of these elections will check the executive, because right now, the executive in the US, the president and his cabinet, they are seen as a government that's anti-business. They want to tax businesses more. They are not fair. They are not fair to Wall Street. They are not fair to Wall Street. They just want to take as much from businesses as possible. Okay. Now they are also fighting against, to an extent, They're also fighting against oil companies. They want oil companies to give back some of their profits. All of those things is not what businesses want. Okay, so that just shows us how the kind of effect elections have. For example, now in a country like Nigeria, elections are coming. Investors are watching who's going to win the next election because they already know these people, they know the candidates, they know what is likely to happen. If this guy wins the election, they know what's going to happen. If the other guy wins, they know what's going to happen. There's a particular around the country, the Nigeria, the president that's currently the president of this country, when he won elections in 2015, the stock market crashed. Then he was re-elected again in 2019, his stock market crashed again. What's that telling you? Investors don't have confidence in the economy under the leadership of this president. That's what it means. You see, so that's not because someone says so, the market says so. So, and we as market participants, we are the ones that play in the market. We don't care. We only want to, we're not really particular about party. What we are particular about is who is going to help us make more money, whose policies is going to help us make more money. So if this guy doesn't know what he's doing, and we know from antecedents, from his past, we know that this guy doesn't know what he's doing. If that guy wins the election, it's definitely going to have a negative effect on the country. Okay, that's the thing. That's how important political events are. And when you remember, there's an event in the UK. There was an event in the UK in 2016. They called Brexit. Brexit was a political event. When Brexit happened, the pound crashed. The pound crashed, right? Just a few months ago, let's not go too far. A particular Liz Truss came into government in the UK. What happened? She came up with some ideas that the market did not like. Came up with some things and said, "Oh, we're going to cut the budget. We're going to increase the budget. We're going to give everybody stimulus." The market was like, "What is this woman doing?" What happened? Pound crashed. The pound crashed so heavily until she was removed. You see, that's the effect of political events on the markets. And a lot of people made money from that crash. A lot of people lost money too, especially the pension funds in the UK. The pension funds were in trouble. The central bank had to bail them out because the market literally reacted negatively to that particular government. You see? So let's go on. Then these are events. Okay, so basically what we've done now is we've looked at the events that move the market. These are what they are. These are the broad categories. The broad categories of events that move the markets. We just went through them right now. You can scroll again and look through. So we said interest rates is number one. Interest rate. Then number two is inflation. CPI. CPI is consumer price index. Okay, these are the things, these are the economic events that move the market, and they are released every month. Most of them are released every month, not all of them. The interest rate decisions are not done every month. They are done 7 to 8 times a year, depending on the government, right? So, but inflation are released in most of these data I'm talking about are released every month. So as a trader, you can look into them every month, and you can use them to trade and make money every month. For example, the inflation numbers for the United States are going to be released on Thursday of this week, which is the 12th of this month, which is on Thursday. It's going to be released. That gets released every single month. Okay, so the next one is employment. The next one is GDP, which is gross domestic product. Then we have political events. So now let's go into the main events themselves that gets released every month. Okay, so we'll start with USD events. USD events. So USD events, number one is non-farm payroll. That is basically non-farm payroll, average hourly earnings, unemployment rate. You can see all that has to do with labor, employment. We talked about that just now. That's one of the things that move the market. All that has to do with employment. Then you see FOMC. FOMC is interest rates. You see? So interest rate is called FOMC. And this gets released 8 times a year, 8 times a year. Okay, the first one for this year is on February 3rd. The first one for this year is on February 3rd. The next one is JOLTS job reports. You can see job is there. That is employment again. So it will move the market. ADP non-farm employment change. You can see there, employment. It is definitely going to move the market. This data I have here, these are the most high impact data. This is not all of it. Okay, this is not all the data that comes from the US every month. There are lots more than this, but these are the most important ones because there are events too that do not move the market. There are events that get released, but they don't move the market necessarily. So we are focusing more on the ones that actually move the market. Okay, so these ones are the ones here right now are the ones that move the market. So what it means is when we say move the market, it means that when this data is released, it has a huge tendency of moving the market, of creating volatility in the market that you can take advantage of as a trader to make money. Okay, that you can take advantage of as a trader to make money. These are the ones. There are some other ones that come out, but they don't have much effect on the market. But these ones have a lot of effects on the market. Okay, so you have ADP non-farm employment change. That one is employment too. Then you have CPI, core CPI. We said that's inflation. That's the inflation numbers from the US. That's going to be released this week. Okay, the whole market is waiting for it. Then Fed member speeches. Now, when you see the FOMC here, FOMC is called the Federal Open Market Committee. So the central bank is usually made up of a governing body. The central bank has a governing body. Okay, so this governing body is usually comprised of a few people, maybe 10 members or less than 10 members. This is the same thing all over the world. Right? So it usually comprises a few people. And what they do is they come together and they are the ones that make decisions on interest rates. They are the ones that make decisions on a lot of monetary policy related events. Okay, so they make a lot of what interest rates, what was the interest rate going to be? There are a lot of things that they do. So, and the members of this committee, usually within the month, they will grant speeches. They will be invited to different events or different programs where they speak. And whenever they are speaking, investors will be watching to listen to what they are saying. Because what they are saying, remember, whatever the Federal Open Committee meeting is doing, or whatever that committee does, is top secret. They don't leak it anywhere. They only release it on the day that they meet, that particular day that is in the calendar. So, like I said, the first FOMC is the first week of February. Whatever the Fed is doing right now, Federal Reserve is doing right now, it is top secret. They don't hint it. They don't give you hints. They don't, nothing. No, the market has no idea. The market has no way of knowing. The reason for that is this. Whatever the Fed is doing can be used to make money. This decision the Federal Reserve is going to make is going to be used to make money. So see, if it's going to be used to make money, they want to hide it, because if they don't hide it, some people are going to get a hold of it and they're going to use it to make money. They're going to use it to make money against other people. It's like it's like two people playing in a market to make money, or let's say you are playing on a particular platform where money can be made, and one person has insider information, the other one, you are in a casino, for example. One of them has insider information. He knows the cards that's there. So he can play it against the other one. But the other one just came in like a novice. The one of them has a card. He knows the card. He knows what's under it. So he has insider information. This is the reason why the central bank keeps whatever they are doing a top secret. So whenever the members go out and they are having speeches and they are talking, people tend to want to pick up hints of what they are doing from what they are saying. Okay, they say that interest rates are going to be, we believe that we should increase interest rate. Oh, so this is what they are thinking. They are thinking they should increase interest rates more. Okay, then they listen to another one, and the one says, well, we think interest rate, we think inflation is coming down right now. We think we should not be increasing interest rates so much. So the market picks it. Oh, okay, that means they are probably thinking that they should not increase interest rates. Do you understand? So this is how the market continues to pick up on the speeches of members of that committee. So whatever they say, move market. Whatever they say, move the market. Just today, as I'm speaking this evening, there was a conference in Europe where they invited the Federal Reserve Chairman to come and speak, and the whole market was watching, waiting to hear what the Federal Reserve Chairman, Jerome Powell, is going to say. Incidentally, he didn't even say anything that has to do with policy. He didn't say anything about their operations, just nothing. Just talked about the independence of the Federal Reserve and all of that, nothing else. He didn't talk about anything else, right? So these are the things. That's one of the things that the market waits for. So another thing is core retail sales. Core retail sales has to do with the economy. How is the economy doing? When people are spending a lot of money, in sales, when in buying things, that means the economy is doing well. That means they are making money. That means they have money to spend. If the core retail sales numbers are high, it means that the economy is doing well. If the core retail sales numbers are low, it means that the economy is not doing well. All of these is what everybody is watching. Investors are watching it. And these investors have a lot of money. That's why I said, as traders, we are following this money. We are following the money. So we have to watch these events. We have to watch these events. Make sure that we're following what is happening there. Then the last one here is core PCE. Core PCE is also like CPI, is inflation. But this one has to do with individuals. The CPI is broad, is very broad. But core PCE is basically data from individuals. Now for CPI, they can be looking at data from the market, from supermarkets, from all kinds of things. They sample data from a whole lot of places. The housing market, so many things. But from CPI, core CPI, they remove energy costs, they remove food costs. But for PCE is actually the inflation data that the Federal Reserve watches the most. PCE, core PCE is the inflation data that they watch the most. So PCE, price index, is also inflation. So like we said before, when inflation is high, it means the Federal Reserve is going to do something. When inflation is low, it means that they're going to do something. You see, so these data, you just need to take note of them and mark them on the calendar. When is this one coming out? When is FOMC coming out? When is Job report coming out? When is ADP for non-farm coming out? You mark it there. Oh, everything is on Forex Factory. Everything is on investing.com. Everything is there, and they are usually scheduled way ahead of time. Okay. So the next one is for Euro events. Euro, you have the main refinance rate, you have the monetary policy rate. The monetary policy rate is also like interest rates. So from what we outlined earlier, those events, those broad categories of events, interest rates, inflation, employment, is the same thing that applies to all economies, all of them. But it affects them in different ways. And what you have to also know is that these events you're seeing here, they all don't move the market the same way every month. There are times non-farm payroll will move the market very heavily. There are sometimes it doesn't. It just depends. The way it affects the market every month depends on the mood of the market. For example, now the CPI for this month, which is going to be released on Thursday, is something the market is waiting for, very importantly. Why? Because it will determine a lot of things. It will tell the market whether the Federal Reserve is going to increase interest rate next month. Because if they are going to increase interest rate, by how much are they going to increase their interest rates? That's going to matter. There's a lot of things hinging on these inflation CPI numbers that will be released on Thursday. But it's usually not like that every month. It's been like that now for a couple of months because the last few months have had high inflation. But whenever inflation, when the economy stabilizes again, probably towards the end of next year into 2024, you will see that inflation numbers may not be so important every single month. You see, so if they don't have the same effect every month. But as traders, what we need to do is basically watch them. Okay. So these are Euro events. Then we go to card events. Card events also card CPI. That's inflation from the Canadian economy. Then you have core retail sales. The same thing. The market wants to see, are people buying more or are people not buying more? Are people buying more or are people not buying more? When people are buying more, it means they have money. It means the economy is doing well. It means that they are getting paid well. When the sales numbers are coming down, it means that the economy is not doing well. It means that people are afraid of spending. It means that people are losing their jobs. It means that the economy is not that strong. You see, that's how this matters. And whenever the numbers are positive, the currency will rise. That particular currency will rise. Whenever the economy is doing poorly, that particular currency will fall. That's just the basic thing. But the extent to which it rises or the extent to which it falls is what we are watching as traders. It will have different impacts on a month-to-month basis. It can be higher some months, it could be lower some months. So we have BOC monetary policy report. That one has to do with interest rate. Anywhere you see overnight rates, policy reports, rate statement, just know that refers to central bank interest rates. Okay, the name can be different, but for different economies, they call them different things. In the US, you have FOMC, but in Canada, you have BOC policy rates, right? So all of that is the same thing, but it's for different economies, and they call it different countries, and they call it different things. The employment change and unemployment numbers. We said before, employment always affects the market, because the central bank, everybody's watching employment numbers. When employment is high, it means that the economy is doing well. When employment is low, it means that the economy is poor. And whenever the economy is doing well, the currency will rise. Whenever the economy is doing poorly, the economy will fall. And that currency will fall as well. Okay, so GBP events, you have GDP, you have monetary policy rates. You see that monetary policy again, MPC, bank rate, that has to do with interest rates. Then you have MPC official rate, that has to do with rates as well. Okay, there are a few more events. These are not the only events, guys. There are many more, but these are the ones that have the most impact on the market. We said the most impactful events. These are the most impactful events, guys. Then you have JPY events. You have monetary policy statement, monetary policy rates. The events from JPY, from the Japanese economy, don't have a lot of effects because the economy is very stable. It's a very stable economy. Okay, a very stable economy. They make sure things are stable. They don't raise interest rates anyhow. Inflation doesn't go very high. A lot of things in Japan are just stable. The economy in Japan is very, very stable, right? So even bond rates, we know that bonds usually have lower yields than investing in stocks. When you invest in bonds, it's like a guaranteed investment, just that the interest rates are very low. The bond rates in Japan are also very low, right? So everything about them is stable. So you don't see a lot of events from Japan that move the market like that, right? Except Japanese, the BOJ intervention. BOJ is Bank of Japan. Sometimes they intervene in the market. If their currency is doing poorly, they might just intervene, spend billions of naira to intervene, push the market down or push it up somehow, just to make sure that they stabilize their currency. But besides that, you will see most of the time, they do not do events, they don't release events that move the market like that. Okay, because they have a stable economy. The AUD events, the same thing. You are seeing CPI, you see employment change, you have cash rate. Cash rate is the same thing as interest rate. ROBA monetary policy is the same thing as interest rates. You see, so it's the same thing. NZD is the same thing. Employment change, you see, it has to do with employment. then official rates, it has to do with interest rates. These are the things that move the markets. They move the market all the time they move the market. But like I said, the extent to which they move the market varies from month to month. Okay. Then when it comes to commodities, what are the events that move the market, move the commodity market? You have crude oil and commodities. First, you talk about gold. Then you talk about WTI. WTI is West Texas Intermediate. It's basically American oil, US oil. Okay, I would have added that, the US oil. WTI is called US oil. Brent is UK oil. Right? So what are the things that move the oil market? You're talking of crude inventories. Crude inventories has to do with what is the inventories of crude oil determines the price. If the OPEC is, we know what OPEC is, the Organization of Producing Countries, right? Led by Saudi Arabia. So what they do is that usually they will have meetings and they will say, okay, we want to cut the number of oil we are pumping out every month. Whenever they do those cuts, whenever they reduce that cut, the amount of oil, the number of barrels, they have millions of barrels they're pushing out, it affects price positively. Why? Because whenever there's a cut in supply, demand remains the same, price will generally rise. Okay. So, and then also geopolitical events. For example, when Russia war started, the price of oil shot up. Why? Because Russia was a major producer of oil. That's number one. Number two, the world economy is going to have a shortage right now because the world is not going to consume as much oil as before. So that also is going to weigh on oil. That happened for COVID. When COVID came, oil crashed. The price of oil went to negative at one point. Why? Because everybody was locked down. Who's going to be using oil now? Who's going to be buying gas? Who's going to be buying fuel? So that had a negative effect on oil. But then, whenever the economy is not doing well, whenever the economies of the world are not doing well, it has a positive effect on gold. Because gold is called a safe haven currency. So whenever there's war, whenever there's COVID, during COVID, gold went to over $2,000 an ounce. Why? Because whenever the economies of the world are doing poorly, gold will benefit because people tend to invest in gold because they have more confidence in gold. That's why they call it safe haven commodity, safe haven assets. So whenever everything is doing well in the world, people don't seem to invest in gold like that. But when things go bad, wars, COVID and all that, people tend to hide their money and put their money in gold. Okay, so these are some of the things that affect the market. And whenever these events are released every month, they have an impact on the market. Okay, so probably what we're going to do is that we're probably going to show. I wish I had some more time, but we are totally out of time. So probably on another class, I'll pull up Forex Factory and investing.com, and actually we'll go through the whole chart. We'll go through the calendar to actually pick out these different events. But for you now, right now, you can go to Forex Factory right now and start to pick these events yourself. You can actually go there now, look for all these events that I have stated here. Look for them. If you're taking notes, you'll be able to go back now and look for those events. FOMC, when is the next FOMC? When is the next CPI? When is this one? When is that one? You can see them. They are on the calendar right now. They are on Forex Factory. They are on investing.com. They are there right now. Go there and check for them. And then mark them down and say, okay, what am I going to do? Even if you're not trading them right now, just wait. Like I said, there's CPI report on Thursday. When that report is out, watch it. Watch the market and see how it affects the market. And see how much, even if you're not trading it yet, just watch and see. You see how sometimes assets will move 300 pips in 1 hour. 300 pips, 400 pips. A few weeks ago, I saw USD JPY moved over 400 pips within 15 minutes. GBP USD crashed during Liz Truss. GBP USD crashed over 400 pips in 6 minutes. 6 minutes, right? So all of these happen because of news events, okay? So now what we're going to do is we're going to go back and start to do that. So we're going to stop the class here so that we can ask a few questions.